Welcome, everyone. Thanks for coming to hear Joe Gagnon from the Peterson Institute talk about a really interesting article he wrote a few weeks ago entitled "Inflation Fears and the Biden Stimulus. Look to the Korean War, not to Vietnam." There's been quite a debate for anybody who's been following the markets in the last few months about inflation and what to expect and so on. And so I'm really looking forward to this talk. I've known Joe for a long time. I think we met at the club longer than we can remember ago. And Joe has been a senior fellow at the Peterson Institute since September of 2009. He served a stint at the Federal Reserve Board in various capacities. And he also worked at Treasury. Joe did his undergraduate at Harvard and his PhD in economics at Stanford. Joe, thank you very much for talking. We look forward to it. Joe will present for about 25 minutes and then we'll open it up for questions. Be sure to put your questions in the chat and I'll call on you.
All right, well, thanks, Pete. Thanks for that great introduction. And I'm happy to be here today. I don't have any April Fool's jokes, but it's an honor to be here. Next slide, please. I'm going to start with what the current inflation forecasts are out there. We're going to look at the PCE inflation because the Federal Reserve targets PCE inflation. And I'm going to look at core PCE inflation because the Federal Reserve tends to look through volatile commodity prices and focuses a bit more on core. What you see in 2021, the FOMC, Federal Reserve Open Market Committee, projects about 2.25% inflation this year. Consensus of private forecast, latest issue, March this month or last month, had only 1.9%. I don't know how much of that reflects a slightly different basis of year on year, but I tend to be with the Fed. I think 2.25 is reasonable, maybe even a touch more for this year. There's some base effects going on, payback from unusually low inflation last year, so you expect some rebound this year. Fed expects that too and would look through that. That's not really the issue. The issue is 2022. Both the FOMC and the consensus of private forecasters has inflation going back to 2.0% in 2022. The bond market, well, look at 5-year inflation compensation bond market, that is higher. It's more like 2.5, but that's on a CPI basis, which tends to run about 0.3 higher than PCE anyway. And on top of that, that includes oil effects, which tend to affect that measure a lot. So, and there might be an inflation risk premium. So that's pretty much consistent. The bond market isn't saying anything more really than this. I think this is too low. I think we're likely to get more. So next slide, please. So why do I think inflation is likely to rise in 2022 rather than fall? So I guess I'm optimistic about the vaccine success. Seems to me the news about the vaccines has been good, even though we have a new wave emerging because many Americans are not yet vaccinated. I think vaccines are progressing rapidly through the population and they seem to be very effective, and including against new variants. Now, if I'm wrong, and the pandemic lingers through the rest of the year, then I think that would affect this forecast tremendously. And I think the Fed and most private forecasters have included some probability of the lingering pandemic in their forecast. They aren't ready to move to a full vaccine end of pandemic scenario yet. And that's one thing holding their forecast back, I think. But I'm going to go on the assumption that we do have a economy reopening. And that would lead to some recovery all by itself without any other factors, just because you could reopen sectors and it would be self-sustaining. We're already seeing large upward revisions in 2021 Q1 data. Forecasts are coming in very strong. The output gap, as of the end of last year, 2020 Q4, the CBO says that was about 3% of an output gap. I think it's more like 4 or 5%. And the largest output gap estimates I've seen that are plausible are maybe 6% for 2020 Q4. Now, if you look at Q1, we're probably already gaining, closing the gap by 1% just in the last quarter. So that would put the range at 2 to 5%. So the output gap is already less than 5% and closing fast. On top of all this, you've got two stimulus packages, where 13% of GDP, and you've got an overhang of private saving last year that is 7% of GDP above what the trend would have been. So that's a combination of 20% of GDP in spending power being added to the economy that was already recovering and didn't have that big of an output gap. On top of that, you've got record stock and housing prices. Household wealth is at a record level. You've got easy monetary policy. Normally, if we think the multiplier, the reason a multiplier would be less than 1 would be because the Fed's going to tighten in response. The Fed is saying it's not going to tighten for the next 3 years. That would support a higher multiplier. And then we have the infrastructure package, which I'll come back to. It seems to me all these things point to the possibility of a much larger demand than supply by 2022, by an amount that we haven't seen since World War II, and I'm not exaggerating. Why don't you go to the next slide, please? So I think there are some special factors holding the forecast down, however, which I think need mentioning. And I think that if you talk to private forecasters, this is what they'll tell you. In addition, as I earlier said, that they're not quite ready to write off the pandemic. In addition to that, even if the pandemic ends, I think they're thinking that household saving will actually not plummet so much. That households might revise up the amount of household wealth they want to keep. If you look at World War II, during the war, because of rationing, there was forced savings. And then when the war ended and the rationing came off, the saving rate plummeted, but it didn't go below the previous trend by any significant amount. It sort of just went back to trend. If that's the case now, then you would not expect last year's boom in household saving to be spent anytime soon. Also, to the extent that the stimulus came in early in this year when the pandemic was still holding spending back, you wouldn't expect all of that to be spent either. So this would argue for a lower multiplier. On top of that, millennials are seeing really high house prices that need high down. Interest rates are low, which is good, but they still need a down payment, which is much larger historically than would be relative to their income. And then some baby boomers really entered with very poor retirement accounts and may be happy to have the stimulus checks and the stock prices to help them out, and they'll save that and hang on to it rather than spend it. That's all possible. The other thing is that states are doing better on revenues than we might have thought a few months ago, and they're likely to save a lot of the stimulus payments. So this argues for a lower multiplier. Also, a number of employers, my colleague Karen Dinan has said a number of employers have introduced productivity enhancements under COVID that enable them to get by with fewer workers. And this might actually boost potential output maybe by 1% over the next year or two. So that would allow us to grow faster without inflation. And then finally, I think the anchoring of inflation expectations, which I'll talk about more later, is really encouraging a lot of firms to sort of do implicit rationing rather than price increases. And if anyone who's tried to buy a large home appliance in the last 12 months may have seen this, because the lead times are very long to get these large big ticket items, and you're really strongly pressed into buying a higher end model, a more expensive model than you would like, just to get a faster delivery time. And of course, this does not show up as inflation, but it should. Similarly, I think we're going to see lines outside of restaurants rather than higher prices, and that's a form of rationing. Now, I could put all these considerations and run a Phillips curve model and try to forecast inflation, but the uncertainty over these multipliers is so large. This is such an unusual thing. We really haven't seen something like this since World War II, that I didn't think it was worthwhile. I just want to say there's a tremendous boom in demand coming relative to supply, but there are reasons to think that maybe the multiplier will be low. So turn to the next slide, please. one thing I just want a digression, but what about the infrastructure plan? Does that factor in? I don't think that factors in very much if we're focusing on the next 2 years. The spending in this Biden plan that was announced yesterday doesn't even begin until 2022, and it starts at a very low level. There's long lead times for these projects. It doesn't peak until 2024 to 2026, and then only a little over 1% of GDP, of which a little bit more than half is going to be funded by front-loaded corporate tax increases. In fact, if they get the corporate tax increases and they start right away next year, if anything, this will be contractionary or neutral next year. So in terms of inflation over the next couple of years, I don't see this as very big. It's not that huge on an annual basis and is not front-loaded. And moreover, I think people like Larry Summers have been saying that sort of an infrastructure program is sort of the best antidote to secular stagnation to boost the productivity of the economy and to raise the neutral real interest rate. And this is not a huge thing. 1% of GDP is not too scary. Other spending to come besides infrastructure, sort of more of the education, social program type elements, I'm told are not going to be any larger and probably smaller than this infrastructure plan on net, and will also be partially funded by tax increases. So it doesn't seem like there's anything really scary going forward. So next slide, please. So the bottom line is I think that inflation of 3%, perhaps there's more even, but maybe 3% is my forecast in 2022, possibly spilling a bit into 2023. That's sort of what I expect to see. But I think it will return quickly to 2% because of the anchoring of inflation expectations, as we'll come to. I do think, however, this is a bit of a digression, but it's important to me. I think that the inflation target we have now is too low given the zero bound problem that we see around the world. The Fed should take this opportunity, if it happens, to raise its inflation target to 3. It's not going to say that in advance, obviously, but I think if it comes out the way I project, that would be a good opportunity to do that. I think a higher inflation target would actually mitigate the zero bound problem by more than you might expect, but that I don't have time to talk about today, but I'm happy to answer questions or point you to papers I've written in the past. Next slide, please. So one of the criticisms that we've heard about the stimulus and the inflation is that it will be costly for the Fed to return us back to 2% inflation. If inflation goes above 2 by a significant amount, it will be difficult. And it's true that previous Fed attempts to rein in inflation have caused recessions, most famously the 1980 and 92 recessions under Paul Volcker, but also 1969, 1974 were cases where the Fed raised rates and caused a mild recession or medium recession because of inflation. But there are other episodes where the Fed tightened and it did not cause a recession, or at least not within 2 years. 1988 and 1994, 2005 are all examples of Fed tightening that didn't cause an immediate recession. I think that if anything, I think that I'm more optimistic about that going forward. I don't think we're likely to see a repeat of the 1970s. But why don't we now turn to, what caused the 60s? What was going on in the 60s, 70s, and is it something we should fear? So the next slide shows the U.S. inflation experience in the 60s. This is 1964 to 1970. It's the CPI inflation rate, headline CPI inflation rate in that period. And what happened here was that in 1965, the United States entered the Vietnam War in a big way with large-scale mobilization and big ramp up in defense spending. And the Great Society programs of Lyndon Johnson were also kicking in. So double-barreled federal spending that pushed the economy way over potential. The CBO estimates that the unemployment rate was a full 2 percentage points below the national rate, which we had underestimated at the time because all the baby boomers entering labor force actually raised the natural rate and we didn't know it. But we were overheating the economy by much more than we realized. for 4 years in a row. We have not had an overheating of the economy like that ever since. We might get it now, but the interesting thing was that this went on for 4 years in a row, and the Fed never really got to grips with it, never really returned inflation back to where it was. I mean, it did. There were some Fed tightenings in here, but they were always half-hearted and they were always quickly reversed, and inflation was never returned convincingly to its previous trend. And it took 5 years. This is a chart showing 5 years of slowly grinding up inflation and Fed half-hearted responses before inflation expectations were finally unanchored. And the icing on the cake was when we went off the gold standard in 1970. And then after that, after this 5 years of rising inflation and ending the gold standard, then in the 1970s, inflation expectations were unanchored. Then what you had is that even smaller excesses of output above potential caused larger inflationary swings in the 1970s. And that was the bad experience that people talk about. But keep in mind, it took 5 years to get there, 5 years of Fed inaction to get those expectations unanchored. I think a more realistic example is the next slide, which is back to the 50s. Because this, I think, reflects the environment in which people are now living. We had an inflationary boom after World War II, and then a mild recession, which killed that inflation. And in 1950, we were coming out of the recession quite well. And in June of 1950, North Korea invaded South Korea, and we immediately mobilized for war. And there was an immediate large upswing in prices. As you can see, inflation went up to 10% from a negative value within 1 year, but it dropped back to below 2% after 1 year. And the Fed didn't have to tighten or cause a recession to make that happen. Now, I think there's a couple things, one thing that's similar and one thing that's different from now. The different thing is that back then, people had vivid memories of wartime rationing and price controls. And in fact, there were price controls put on in the Korean War, and people tried to raise prices to beat that. And that's why you saw a very rapid run-up in inflation. I don't think there's any chance we get such a rapid run-up now because people aren't trying to beat price controls. So that's an element that's not relevant. But I would note that price controls were fully removed in 1950. By January 1953, they were fully removed. And as you can see, there was no lingering inflationary pressure. So this wasn't a case of price controls really mattering that much, and rationing was never imposed. So what happened was we just had a burst of aggregate demand, a burst of inflation, but it went right back to normal. People didn't expect it to continue, and it didn't. And the Fed didn't need to cause a recession to make that happen. And I think that is a relevant example for today. So let's turn to the next slide. Okay, and next bullet. So as I said, the Fed has, over the past 30 years, built up valuable credibility on inflation. I think people now think about inflation the way they did in the 50s and early 60s, before that long period in the late 60s that removed that anchoring. We're back to where we were before the late 60s. And then in that environment of anchored expectations, any given demand shock has a smaller effect on inflation, okay? And so that's good. Also, as we saw, credibility is not lost quickly. One year or even 2 years of inflation is not going to be enough to do it. It took 5 years of massive overheating in the late 1960s to push inflation up by 4 to 5%. So that gives you a sense of how hard it is to get sustained inflation. Not that it's impossible, but it's not going to happen in 1 or 2 years. And next bullet. But once credibility is lost, then inflation does respond more quickly, as we saw in the 70s. Well, I didn't show you the 70s, but it's happened in the 70s. It didn't take such large booms in the economy to cause inflation after you lost that credibility. And that was bad. We don't want to go back to that. And then we learned under Paul Volcker that restoring credibility is painful. We had a very bad recession was needed. Okay, so Next slide. I think that the Fed will respond this time. I think the Fed was just a while absent without lead in the 1960s and 1970s. Next bullet. It did not, in that period from the mid 60s to the 1979, it never communicated clearly any objective they had for inflation. Next bullet. It continually blamed inflation on a series of special factors and always tried to say the Fed wasn't responsible. Next bullet. And any half-hearted attempts it made to control inflation were quickly reversed before inflation actually had been controlled. So this was just a series of Fed mistakes that I do not believe will be repeated. However, it's sort of ironic that the Fed has adopted a new inflation framework just when this is just before this COVID shock happened. And why do I say that? Well, the Fed, as you may know, adopted a new framework for inflation that forces it to wait until it actually sees inflation before it tightens. Before that, it was a little preemptive. But what we saw in the past 10 years is that the Fed was continually undershooting its inflation target. Whenever inflation would get up to 2, it would go back down. It never went above 2. And we have 10 years of that. And I believe the reason for that was that the Fed overestimated the natural rate of unemployment and the natural rate of interest. And so those go into a Taylor rule for Fed policy, and the Fed responds by setting interest rates according to that rule, but they had the wrong estimates for the natural rate of interest and the natural rate of unemployment. And so they were too tight and they didn't know it. And so the inflation kept coming in lower than they expected. And they did that for 10 years in a row, and they revised down their estimates, but they were still behind the curve. And then they finally said, well, we've got to get ahead of this. We got to do something different. So they have a new framework, and the new framework sort of basically ditches the Taylor rule and says, no, you got to actually see inflation before tightening. However, it's a little ironic that just after they adopted this new rule, they get the biggest macro shock that has happened in any of our lifetimes. Next bullet. So it's sort of, it's unfortunate perhaps, but I think the Fed now is stuck with not being able to proactively respond to the stimulus. We're just going to have to wait and see how it unfolds. And there's a lot of uncertainty of how it will unfold. I mean, I've given you my forecast, but if you think the multipliers are going to be historically low on this on the stimulus, then you might think no inflation is coming. Fed's going to have to wait and see. Anyway, final slide. So, as I said, I think a moderate burst of inflation is likely next year, 2022. I'm talking about 3%, not double digit or even high single digit, but 3%. Maybe it could be more. I mean, there's a wide range of uncertainty, but I'm writing down 3 is my sort of best guess. Next bullet. If this is seen as a temporary adjustment to the COVID recession, then I think it should be, inflation is likely to drop back quickly. I think the long-term deficit plans of the Biden administration so far are not scary, especially given the negative real interest rates we've been having. You can run more deficits than you could in a positive interest rate world. I think if we think of this as just being a sort of adjustment to the COVID recession and recovery, it shouldn't scare people too much, shouldn't upend inflation expectations. But the Fed must communicate clearly what its plans are, what its objectives are, and act if needed. And so what I'm thinking is that I don't think the Fed needs to act this year at all. I think the real rubber will hit the road, so to speak, in first quarter of next year. Then we'll know whether inflation is falling back towards 2 or rising further above 2. And then the Fed will need to confront it, and it will be important. But I don't think it needs to overdo it. I think a moderate increase will be enough to show the markets that it sees what's going on. It doesn't need to slam the economy into recession. It just needs to convince everyone it's aware of the situation without killing the economy. However, final bullet. I think, and this is just me, but I think that if this all happens as I predict, I would like the Fed to seriously consider raising its inflation target just a bit because of the zero bound problem. If you thought that 2% was the optimal inflation target 20 years ago, as many did, what we've learned since then about the problem of the zero bound and the neutral real interest rate suggests that a higher inflation target must be optimal now if 2 was optimal then, just because all these new developments, especially the zero bound problem and the lingering recessions we see in Japan and in Europe, argue for more running room for central banks to stabilize their economies. And even a 1% increase in the inflation target, which would be pretty small, would actually give a meaningful power to the Fed to help fight a future recession. And I'll stop there, but I'm happy to take questions.
Thank you very much, Joe. Great talk. Robert Sharetta is going to ask the first question, and then Bert Ely, and then Hervé Bronstein.
Okay, Pete, my internet connection is a little unstable. I hope you can hear me okay. Simply put, I would like to ask our speaker, just saw an 11% in the price of housing. So we see housing continuing to rise. That's even true for rental markets as well. Healthcare costs continue to rise for the average consumer, and who knows what will be adjusted when all the costs are calculated for the COVID environment. And finally, labor costs, not just the minimum wage, but we see the possibility of unionization taking place in Amazon, et cetera. Are you comfortable that the current measures are capturing those big inflation items?
Pete, do you want to each question in turn, or do you want to collect several?
I'll go ahead and answer each one. Thanks.
Okay, sure. I think that our measures of inflation are pretty good. I don't worry. I don't think that's a first order problem, but I do accept, and I even hinted at that. I think there'll be a little hidden inflation in the sense that of sort of rationing, forcing people to wait longer for things, or be forced into buying higher end models than they expect. And maybe that can occur in housing and healthcare to some extent too. I don't know, but I think that, I mean, I'm not an expert in how price data are gathered, but I'm not worried that rental rates and healthcare prices aren't going to show up. I don't know. Perhaps I'm just not an expert enough in the micro details of the data, but I don't have a strong reason to fear. And we also obviously collect lots of good data on labor costs and wages and other labor related measures. So I think that I think is definitely going to be easy to see.
Bert?
Okay, can you hear me?
I can hear you.
Okay, good. Given the relatively low nominal interest rates today, why is even 2% inflation desirable if, as a consequence, real rates are close to zero or even negative? And as a follow-on question, how concerned are you about asset price inflation, such as house prices and equities, given today's low nominal rates?
I guess I'm not sure I understand your first point. I mean, nominal rates are low. In my view, they're too low. Is that your concern?
Well, no. My question is what that means effectively is that even given the low nominal rates, if you get much of a boost in inflation rate, you're going to have negative real rates, and that is hardly good for investors and savers and pension funds.
Oh, okay. No, well, then I just disagree with you on that. I think we need negative real rates. I think that's the lesson of the past 20 years in Japan and 10 years here. A number of factors: slow productivity growth, slow population growth, and the nature of technology all conspire to reduce investment demand and increase saving demand, and have pushed down real rates all around the world. And there's no theoretical reason why the real rate needs to be positive. Again, this is on safe government assets. So, I mean, the real rate on risky assets is still positive. But the real rate on what we're talking about, government bonds, indeed should be negative. So I guess I disagree. In terms of, housing prices, well, I tend to believe in the standard thing that what we care about is the price of goods and services of current consumption and not assets. I mean, house prices are high because real rates of return are low. And so for any given rent, which is what we care about, you would want the house price to be high because you need the return on housing to be low. That's sort of what the equilibrium of the economy is telling us. If you don't like that, then have more babies, because have more babies, have more children, have more immigration, and have more productivity growth and technology growth. Those are the ways out of this low interest rate world.
Hervé, you want to unmute?
Yeah, I just unmuted. Thank you. Having a 2% inflation target, by the Fed, to me means that as long as inflation is 2% or under, the Fed is basically going to sit on its hands. If you take the inflation target up to 3%, does that mean that the Fed will continue to, sit on its hands, that is, not tighten interest rates? Or does it have to get up to 3.5%, 4%? At what time do the lights start flashing at the Fed?
Well, in terms of starting from where we are now with a 2% inflation target, and the Fed has said it wants some overshoot over 2, so the lights will not start flashing if inflation is 2.25 or even 2.5 for a year or so. But I do think that inflation, after a year of 2.25 to 2.5, if inflation continues to rise up as opposed to drifting back down, then the lights will flash at the Fed. And so I think my 3% projection for next year, 2022, would definitely get the Fed's attention and cause them to do things, start tightening. However, if they adopt my proposal, which seems unlikely, but I still think it would be the right thing, then obviously they would welcome the 3% inflation and say, no, this is where we want it to be from now on. And then it would have to go above 3 before they would start to act. But at that point, I think there would be less room for cushion. So in other words, since you've just raised the target to 3, you're not going to want it to get to 3.5 or 4 before you start to act. You'll probably want to start acting sooner if it rises above 3 at that point.
Bob Roth, please unmute.
Yes, Joe, one of the things that, when I've looked at this, that I've really been struck by is, when you look across countries at lower inflation, that so much of it is driven by demographics and not just slower population growth. But I'll give you an example. If you look at the annual rate of change in the GDP implicit price deflator going back to 1950, and you correlate that with the growth rate in the following family age cohort, the 20 to 44 age cohort, so that's your prime family cohort, the correlation is over 77% between those growths. And I think what we've seen, you've certainly seen it in the EU, you've seen it in Japan for a couple decades, but slower inflation, but it's more on the good side. Now, granted, globalization, the Amazon effect, the digital revolution, that all has an effect. But even over the last decade with very low inflation, services inflation in the US, look at healthcare, look at higher education and so forth, has been much higher. So raising the target to 3%, would really stress services inflation to a much larger degree. So I think, if anything, in my opinion, the Fed, I think the PCE or GDP deflators probably averaged 1.6, 1.7 over the last decade. Given the demographic fundamentals, I think they've been doing the best job they could. What do you?
So I agree. And so I agree that the Fed has done better than the ECB or the Bank of Japan. But my interpretation of your correlation is a little different. So I'm not surprised that you find correlation between population growth and inflation. But here's what I think is going on. I think what's going on is that central banks around the world just didn't get, and I know that when I was at the Fed, we didn't see this either, that never thought that slower population growth was going to affect the equilibrium interest rate or the equilibrium unemployment rate of the economy. But we now know that it does, because the equilibrium interest rates really are related to growth rates. And if growth is going to slow down because population growth is slower, then equilibrium rates will be lower. You'll have fewer children to build schools for, and to build houses for, and to build factories to give them jobs. And all these demands for investment go down. That lowers the equilibrium real interest rate. And if the central bank doesn't see that, it's going to start undershooting its inflation target. And so you see inflation coming down when these population developments happen because of central bank mistakes.
Okay, thank you.
Joe, I've got one for you. Fiscal policy is certainly crossed over the red line. I mean, we're about to jump over the previous record of public debt to GDP set in 1946 at 106%. And it doesn't look like it's going anywhere other than straight up. I know Congress, and boy, it's almost impossible to find anybody in Congress, neither House, neither party, who cares about the deficit. What does this mean for monetary policy?
Well, I am not too worried. I look in history and around the world, and I see that Japan's, has 200% debt to GDP ratio and has 0% inflation. And I see the United Kingdom had higher debt to GDP ratios in its history than we've ever seen, and they came through it okay. I think countries that borrow in their own currency just have a massive amount of fiscal space that other countries don't have. It's not limited to the US, but any country that borrows only in its own currency has that power. Now, it doesn't mean it can't be abused, but I think in the environment of low population growth, low technology growth, that aging populations are saving a lot. It just has much less effect. But it does say that if those things change over time, and they will slowly, we have to be ready to adapt our fiscal policy. But the good news is that it would be in an environment in which growth is picking up and people are feeling, demand is stronger, and the economy could absorb those tax increases better. So it's not all bad news, even down the road. When we do need to tighten fiscal policy, it'll be in an environment, it would be because the economy is growing faster again. So I'm an optimist, but I do realize that Congress and other governments have screwed up in the past, and there's no guarantee it will work out well in the future. But I don't see it as an urgent threat, and I think it's something that we can, in principle, deal with without massive disruption.
As a follow-up, we have pension bailouts on the order of about $500 billion over the next couple of years. Medicare in a few years after that, and then Social Security to bail out by 2034. So what about those?
Well, I'm optimistic because we just waste so much healthcare spending here that if we just moved to the efficiency of Europe or Japan, we would save 4 or 5% of GDP in healthcare costs. And that goes a long way towards addressing those problems, and that's a one-time transition. It's true, but it's a one-time transition that can save us 10 years worth of these trends you're talking about. So if we just adopted a more efficient healthcare system, which is not anything unheard of, because we'd just be going to what other countries are already doing, we'd save 4 to 5% of GDP in spending. So that's where I would look.
Okay, thanks. Oliver Fulton Traeger, please unmute and ask your question.
Thanks. So we've seen a big increase in the savings rate that you alluded to earlier. If that increase in savings is skewed to consumers that have a lower marginal propensity to consume, so people with jobs where they could work remotely and were then spending less on retail and leisure, should we reduce our estimate of the impact of that being unwound? Because when that's unwound, those are consumers who, kind of by definition aren't going to be spending all of their savings down that they would have last year. They're not going to be catching up on all those vacations. And how should that impact how we think about that?
Well, I don't think I have any, I think you see that I don't have any insights to give you. I think what you said is this is exactly where we don't know. I mean, this is, if you talk to private forecasters, I've talked to a couple, that are in the consensus forecast, and this is what they point to. They just say, look, there's no precedent for this kind of massive fiscal transfer and change in the saving rate, and how it will unwind. And you could argue that there'll be a lot of pent-up saving, but you could also argue that no, people will take it as a one-time change to their wealth stock and not dissave it. So it's really unknown territory. But as I said, I think that we're likely to get some of both. In other words, we're likely to get continued saving of last year's saving and a bit of this year's saving, but increasing propensity to consume out of income going forward. So, instead of a 20% demand stimulus from all this spending that we've just had, which you could argue would be possible with a multiplier of 1, it's likely to be much less. Maybe it'll be 5 to 10% of GDP. Still more than the gap, but much smaller than a simple multiplier analysis.
Thanks.
Lou D, please unmute and ask your question.
Sure. So is there any evidence that during COVID that we experienced a lot of delayed family formation, postponed fertility? There are a lot of delayed medical procedures, a lot of this pent up demand, not just for goods, but these other kinds of demographic change. And post-COVID, we're going to experience, at least for the next 3 to 5 years, because I think demographics changes last longer than just a push to buy more as a result of higher income, a boom that could push inflation above 3%.
I think that's a risk. I don't have a good handle on it. But no, it's absolutely a risk. I'm writing down 3, and I'm way out on a limb here because, as I showed you, private forecasters are calling for 2, the Fed's calling for 2.0, literally, and the bond market's calling for maybe 2.2, and I'm calling for 3. So I feel like I'm way out on a limb, but I actually think there's upside risk from 3. Yes.
I just don't think that what the Fed and some others are not taking into account is what the effect of COVID is going to be on some demographic shifts during the several years post-COVID. That's all.
Yeah, I agree. I think of it as a risk, but maybe it's your central tendency. To me, it's an upside risk.
David Poppert, please unmute and ask your question.
Thank you, and thank you for having me. I'm glad we got the chance to write our questions because I'm calling from South Africa, and I know that my accent is sometimes difficult for you guys. I just wanted to ask, I've seen work that shows that up till now, we've had aging populations, but that's been accompanied by still positive working age population growth. But that we're now on the cusp of that changing and those labor forces starting to contract. Assuming that's true, do you think it's something that could have a meaningful impact on wage growth and or inflation, on a longer term perspective? So you may be referring to this paper by Charles Goodhart and I think Manu Pradhan, if I get the name right.
and Charles Goodhart and co-author have a paper that basically says what you say, that we've had a lot of negative pressure on inflation from the demographic transition, but it's about to turn. Not rapidly, but it's about to turn, and that would raise inflation pressure going forward. But when I have looked into this, and I have not written on this, but when I've looked into what other people have written, they're only looking at part of the problem. I mean, other people take on board their comment, but also look at other factors and come up with a different conclusion. Basically that no, maybe the rate of downward pressure on inflation and real interest rates is going to diminish and flatten out, but they don't see any rise going forward. And I think that's because the Goodhart and co-author ignore some of the other demographic elements. And I can't actually remember exactly how it goes, what they ignored, but when I look at it, the people who considered more factors than Goodhart at all found that, well, maybe the pressures are diminishing, but they're not reversing yet. So I'm not an expert. Who knows? We weren't very good at seeing this coming in, so maybe we won't see it when it leaves. But I tend to believe that it's not going to leave in a hurry. Now, it is true that that one element, labor force growth, is slowing. Will that put upward pressure on wages? I don't know. I mean, I tend to think that if inflation is whatever central banks ultimately want it to be, I mean, I don't know. There's a whole bunch of issues about, you're talking about the real wage, so I guess that could be independent of inflation, but whether companies have more market power these days, whether that means that they have more monopsony power against their workers, and maybe you're saying that the fewer workers would change that bargain. I don't know. It's tricky. I mean, it might have a lot more to do with labor unions and political support. I just don't know. I don't want to babble on anymore. Thank you.
Chris Smith, please unmute and ask your question.
Yeah, just if you look at relative performance, the US has consistently better results than the European Union or Japan on most metrics, like per capita income, unemployment, things like that. Why would we want to emulate their policy mix?
So what elements are you thinking that we're going to? What do you mean? What elements? What part of the?
Well, higher government as a percent of GDP, public health, publicly financed health, higher social benefits,
right.
negative,
well,
and especially negative interest rates.
Yes. So I think we probably differ as to why we've done better than Europe. I agree with you that we have done better than Europe and Japan. I attribute that to macro policy, not micro policy. So I don't think, my personal view is that healthcare system is actually holding us back, and we're wasting a lot of money on it. But I think what happened in Europe and Japan is that their central banks were less proactive. They didn't get out ahead of this deflationary pressure, and they have basically been operating farther below potential than we are for the past 30 years. And I think we have done better. The Fed has done better at keeping our economy near its potential than the ECB or the Bank of Japan. So it's pure macro in my view. And I don't want to change that, absolutely. And I think, frankly, Jerome Powell is doing the right thing. He's trying to be even more proactive in keeping us at potential, which is good. But as far as the rest, I think that may just be an ideological difference. I don't think that, certainly not healthcare, is not a plus for the US.
We have time for a couple more questions. Put them in the chat. I'll add another question. Joe, we've seen a lot of supply chain disruption, and China controls a large percentage of the rare earths that are needed for semiconductors and batteries. And I mean, do you see that as a factor at all in rising inflation in the future?
I don't think that would be permanent. I thought we were trying to open up, and I've been reading about this for years. It hasn't happened yet. We have massive rare earths potential in our own country, and I thought there was a mine in California that they were trying to reopen 5 years ago. Has it not happened yet? I mean, I don't know, but maybe we'd be caught flat-footed for a couple of years until we could reopen these supplies. Other countries have, in Australia, other countries, Chile, have these rare earths too. So I can't imagine that's a long-run thing, but it might be a short-run thing.
And, you know, a lot of companies are having to move out of China now. I mean, that's temporary too.
Well, China is, I don't know. I mean, who knows? I think China is obviously the big elephant in the room in terms of what the U.S. policy is going to be and how we're going to treat them as a partner or competitor or adversary. I don't have any special insights into that. I mean, I'm worried about China's behavior certainly, but I think it's. I don't want to speculate. But, you know.
Okay, Jeff Whirling has a question.
Yeah, you want me to say? So I just wanted to point out. Oops. Can you hear me? I didn't have my mic on. Sorry. I just wanted to make the point that it's actually healthcare inflation for over a decade now has been quite restrained, as measured by the PCE, health services, and a couple other measures. For a while now, as a matter of fact, because it's such a large weight in PCE, healthcare services disinflation has probably contributed to low inflation over the last 10 years or so. The question is, what's the prospects for that? Since it has such a big weight in PCE, does healthcare services inflation pick up from here and contribute to inflation?
Well, I think in the near term it probably will. And someone mentioned that in an earlier question too. A lot of people put off healthcare, major healthcare expenses last year out of fear of COVID. And that's one of the services things that might rebound, because if you wanted to have elective surgery or plastic surgery or even essential surgery or care of some kind, you're still going to want that, and you're going to want to, you know, schedule it soon, and there could be a burst of that kind of activity, which would push upward pressure on healthcare inflation. It's very different from restaurant meals, where if you didn't have a restaurant meal last year, you're not going to make up for it this year. Healthcare is very different, where you could make up for it. Yeah.
Lou D, you had a comment on healthcare?
Yeah, I'm actually a health economist, and one of the things that I'm seeing is a tremendous shift in technology that happened in healthcare during COVID. You know, in some of the health systems that I've been looking at in the United States, there's a shift from about 7% of telehealth visits to over 30% of telehealth visits, and that's increasing. And a lot of that is going to say consumers seem to like that modality. It's now being evaluated to see how well it did in terms of taking care of patients, and we also see that the cost per telehealth visit is considerably lower than the cost of an in-person visit. So I think that's a modality that's changing. The other thing that happened, there was an acceleration from inpatient treatment to outpatient treatment that's been going on, but now even more procedures are being done on an outpatient basis, and a lot of that was pushed by COVID. So it's too early to say, I think, exactly what's going to happen, but with this shift to less expensive modalities, we may actually see healthcare costs moderate even more from what they did. We may see a temporary increase due to this pent-up demand that we've just been talking about. But I think looking in the long term, the one good outcome of COVID is it's transforming the healthcare system.
Well, that's good news. That's good news, and I hope you're right. And thanks for pointing that out, because I had seen something like that in other sectors, but I hadn't heard that story for the health sector. It's a very good point. What I heard from my colleague Karen Dinan was in other sectors, including entertainment and restaurants and stuff, how restaurants are using new technology to reduce their labor needs there too, that was spurred by COVID, but that they might keep going forward. And so then we could get a spurt of productivity growth, which would mean faster economic growth in the next few years. That would be good news. And it would somewhat lessen the inflationary pressure of all this. But it would also tend to raise the equilibrium real rate, which is inflationary if the Fed doesn't see it.
Okay, we'll go to Bert Ely for the final question today.
Thank you. The United States net international investment position has become increasingly negative, reaching 14 trillion, according to the latest Department of Commerce estimates. My question is this: how much deeper can that negative position go before the US dollar loses its status as the world's reserve currency?
Wow, that's a little off topic, but it happens to be a topic that's dear to my heart. So I've been following it very closely. Some of you may know. Well, you know, that is the $64,000 question. I think in the near term, I think if anything, the dollar is going to go up because I think if the Fed has to do even some small tightening to fight this inflationary pressure, it will be dollar positive. And the massive fiscal stimulus is bound to make our trade deficit worse, which means we'll be borrowing even more from the rest of the world. So, but over the longer term, I absolutely am worried about what you're saying. I mean, our net debt to the rest of the world is 68% of GDP. This is not money we owe ourselves. You know, we used to tell ourselves that story about the government debt. Fiscal deficit was debt we owed our children or ourselves, right? It didn't matter. Well, this is not money we owe ourselves. This is money we, by definition, owe other people. And I do worry that if, you know, this massive spending ends up supporting jobs in Germany, Japan, and China, at least partly, you know, on debt that our children will owe to Germany, Japan, and China to support jobs in Germany, Japan, and China, I don't think that's a political winner. So I don't know how it's all going to unfold, but in the near term, no one's worried about that massive net debt. And in fact, the problem is that people are even so happy to have it. So I just don't know how it's all going to work out.
Joe, thank you for a really excellent talk and excellent Q&A. We will be posting a recording of this and the slides on the Peterson Institute website for anybody who missed it or who wants to review it. So thank you all very much.
Thank you, Pete. It was a pleasure.